Okay, let's unpack this. Have you ever looked at a company and felt like, I don't know, you were seeing two totally different businesses sort of battling it out under one roof? Today, we're taking a deep dive into Meta Platforms. Meta, it's a company that really embodies this intriguing dilemma. We've got this really comprehensive investment analysis on Meta, and our mission for you, the curious learner, is basically to pull out the most important insights, clarify how these, complex pop of the business work together, and give you a clear view on its investment potential. Think of it as a shortcut to getting well-informed quickly on one of the biggest names out there.
Yeah, and what's really fascinating here is how this report just lays out that tension, right? Inside Meta itself, you've got this like hugely profitable core business on one side.
Study engine room.
Exactly. And then this incredibly ambitious, highly speculative future that it's just pouring billions into. It's a real confrontation of ideas, and that shapes everything. And interestingly, the report lands on a clear BUY recommendation. So that sets up a really interesting discussion, doesn't it? Does the market really get this balance? Does it value it correctly?
That really is the heart of it, isn't it? It's like imagining a ship with two completely different engines. One's this tried and true, super powerful diesel, right? And the other's like an experimental high-risk warp drive. So let's jump right into what the report calls the tale of two metas. First up, the family of apps, FOA. This is your Facebook, Instagram, WhatsApp, Messenger, the stuff everyone uses. And it's not just a cash cow, it's like a gold mine. Nearly 4 billion global users. Think about that.
4 billion. It's staggering.
It really is. And it forms basically a near duopoly in digital ads with Google. This chunk generates what, 98, 99% of Meta's total revenue?
Almost all of it.
Its power comes from these incredible network effects. The more people using it, the better it is for everyone. Plus, obviously, massive amounts of user data and really advanced AI for targeting ads. And that AI, that sophistication, is actually what helped them navigate those big privacy changes from Apple's iOS that really hurt some other companies.
Right. And then, completely opposite to that, you've got the Moonshot Reality Labs, RL. This is Meta going all in on the future, building the metaverse, making the AR/VR hardware like the Quest headsets and all the software behind it. But, and this is the kicker, the stark financial reality that makes investors, take a pause. RL brings in only 1-2% of total revenue.
Okay.
Okay. But in 2024 alone, it burned through an enormous $17.7 billion in operating losses.
17.7 billion just in losses.
Just losses in 1 year. And if you look back since 2020, the total losses from Reality Labs are over $60 billion.
$60 billion. Wow.
Yeah. So this brings up a really important question for you, the investor. When you look at Meta stock, what are you actually buying? Is it this stable, super profitable ad giant? Or are you basically becoming a venture capitalist funding a really high-risk, unproven future? And here's an insight, I think. Meta's position, its dominance and profitability, lets it make this huge bet that almost no other public company could possibly sustain without shareholders just revolting. The FOA profits aren't just funding RL, they're like a strategic shield. Competitors just can't afford this kind of long-term gamble. That right there, that's the core dilemma.
That really puts it in perspective. It's not just two parts of a company. It's like two totally different investment ideas rolled into one stock. Okay, so let's shift gears a bit, talk about Meta's place in the market, this really fast-moving digital world it operates in. We mentioned the duopoly with Google. Together, they have something like over 93% market share in their specific sector, internet services and social media. But even with that dominance, competition is fierce, right? Especially for people's time and attention. TikTok is the big one, obviously.
Huge pressure from TikTok.
Yeah, and that really drove Meta's pivot to short-form video, like Instagram Reels. Plus, you can't ignore Amazon growing its ad business or smaller players like Snap and Pinterest grabbing specific audiences.
Exactly. And if we connect this to the bigger picture, the whole industry is being shaped by some really powerful trends. First, like you said, the dominance of short-form video has just changed how we all consume content online. Then there's the rise of social commerce, platforms becoming places you actually shop. In the U.S., they think that market could nearly double, from about $75 billion to over $140 billion in just 5 years.
Wow, that's massive growth.
It is. And then everywhere, the AI revolution. It's improving recommendations, making ads way more precise, everything. All this leads to what the report calls a shift to media networks. These platforms aren't just about connecting with friends anymore. They're becoming places you go to consume all kinds of content, competing directly with Netflix, YouTube, you name it. And beyond those big trends, investors also need to get the cyclicality, the seasonality of this business. Meta's ad revenue, it's tied pretty closely to the global economy. So the report expects maybe slower growth in 2025 because of economic uncertainty, but then a rebound in 2026. And seasonality is super clear. Q4, holidays, always the strongest. Q1, budgets reset, typically the weakest. These aren't just minor details. They really shape Meta's growth path year to year.
It's clear they're navigating some powerful forces, but what gives them the ability, the muscle, to fund reality labs and keep investors happy? It comes down to their financial strength, right? The report calls it a fortress-like balance sheet. Basically, for anyone new to this, it means they have a ton of cash, like $77.8 billion in cash and easily sellable investments at the end of 2024, and not much debt.
Huge flexibility there.
Exactly. And they just generate so much cash from their operations. Their free cash flow, the cash left after running the business and investing, was over $52 billion in 2024. Just incredible numbers.
That financial muscle is definitely a competitive edge, a strategic asset. And when you dig into the ratios, Meta's profitability is just superior compared to its peers.
Right.
Gross margin, 81.7%. They keep over 81 cents of every dollar earned after direct cost.
That's high.
Very high. Net profit margin, 39.1%. World-class efficiency in turning revenue into profit. And return on equity, ROE, is 38.7%. That tells you how effectively they use shareholder money to make more money, way better than competitors like Alphabet or Snap. And, management really deserves credit for that year of efficiency in 2023. It wasn't just talk. It showed real commitment to cost control, capital discipline. It led to this dramatic jump in operating margins and, let's be honest, really boosted the stock price.
A definite turnaround moment.
And then a really big moment, early 2024. They started paying a quarterly cash dividend. Plus, they keep buying back their own shares consistently. This signals, okay, we're maturing. We're focused on returning capital directly to shareholders. That attracts a whole different group of investors, maybe those looking for income alongside growth.
So, great financials, strong position. Which brings us to the big question. Is Meta stock a good buy right now? The report used two main valuation methods. First, a discounted cash flow model, a DCF, basically estimating future profits and seeing what they're worth today. And that DCF model, it puts Meta's intrinsic value somewhere between $510 and $560 per share, based on assumptions like, solid 12, 14% annual revenue growth and strong margins. Now, here's where it gets really interesting. That suggests the stock at recent prices might actually be undervalued based purely on its ability to generate cash.
Yeah, and that DCF view is backed up, or maybe complicated slightly, by the relative valuation. This gives you that kind of mixed picture, hinting at the duality we talked about. Meta's price-to-earnings ratio, the PE, is around 27.2x, so it's pretty reasonable compared to some peers. It suggests growth at a reasonable price, or GARP. You're getting growth, but not paying a crazy multiple for it.
Okay, makes sense.
But its price-to-book ratio, PB, is much higher at 9.7x. That signals the market puts a huge value on its intangible assets. We're not just talking buildings here. We're talking the brands, the massive user data, those network effect stuff that's super valuable but doesn't show up neatly on balance sheet. So the aha moment here, I think, is seeing this duality. Meta is seen as both a solid DARP investment and a speculative high-growth tech play. The market definitely values the core FOA business, the cash machine. But it's also assigning this, significant but uncertain option value to Reality Labs, like a lottery ticket on the metaverse. Put it all together, synthesize both methods, and the report lands on a fair value range of $525 to $575 per share, which again suggests a decent margin of safety compared to recent prices.
That duality really captures the essence of the two metas, doesn't it? Okay, let's talk about what protects that core business, what gives it staying power. The report calls it a wide economic moat. This comes down mainly to those powerful network effects and significant intangible assets. The network effects are just huge. Why is everyone on WhatsApp? Well, partly because everyone else is on WhatsApp, right? It's hard to switch your entire social circle, high switching costs.
Very sticky platforms.
Exactly. And the intangible assets, the brands everyone knows, plus that incredible amount of user data that feeds their AI ad engine. That's really hard for anyone else to replicate. It's a monetization machine.
It is. And yet, despite that strong moat, we absolutely have to talk about the elephant in the room. The risks, they are significant. They're persistent. They create tons of volatility in headlines, and they're the main counter-argument to buying the stock. The report flags regulatory and legal challenges as probably the single biggest threat. Just think. In the U.S., you got major antitrust lawsuits from the FTC, from states. There's even the potential for forced breakups. Imagine having to sell off Instagram or WhatsApp.
That would completely change the company.
Fundamentally. And in Europe, you have GDPR, the Digital Markets Act, strict rules on data privacy, limiting how they can use data for ads, leading to huge fines. They got hit with a $414 million fine in 2023 just from the EU. These aren't small things. They could really disrupt the core business model. Then, intense competition, especially TikTok, keeping the pressure on constantly. And the big one we keep coming back to, execution risk in Reality Labs. That multi-billion-dollar annual spend, over $60 billion lost so far. If that doesn't pay off, if the metaverse doesn't become a real business, that's just a massive destruction of shareholder value. How do you square that circle as an investor?
It's a tough one.
And there's key person risk. Mark Zuckerberg has immense control through the dual-class share structure. That raises governance questions for some investors. Plus, ESG factors, environmental, social, governance. The report notes high ESG risk, mainly due to social concerns like data privacy, misinformation, and those governance issues with the share structure. If we connect this back, these risks, they're the reasons some investors stay away. There are the strong counter-arguments.
Those are definitely serious points. And, for a curious learner, it does seem challenging to balance those massive risks against a BUI rating. How does a company even navigate that and still get a thumbs up?
Well, that's exactly it. It's this constant tension, this tug-of-war between huge risk and huge potential reward that makes Meta so compelling, so complex. Looking forward, there are definitely forces that could push the stock higher. The report calls them potential catalysts. Probably the biggest one near term is successful AI monetization. Better ad performance thanks to AI, maybe new premium AI features, maybe even licensing their Llama AI models.
Okay.
Then continued Reels growth and monetization. They're still working on making Reels as profitable as, say, Stories. Lots of potential there. And a really big one could be unlocking messaging commerce, letting businesses sell directly through WhatsApp and Messenger, especially outside the U.S. Think WeChat in China. That could be a whole new major revenue stream.
Right, turning chat into shopping.
Exactly. And finally, just sticking to that capital discipline and shareholder returns, keeping costs in check, paying the dividend, buying back shares that builds investor confidence and broadens the appeal.
Okay, so those are the potential upsides, the tailwinds. But what about the significant headwinds that could still throw them off course?
Well, the biggest one is still adverse regulatory outcomes. A forced breakup, major new privacy laws hitting the ad business hard that remains the #1 threat, no question. Then there's the risk of sustained Reality Labs losses. If those losses keep piling up year after year without a clear path to profitability, investor patience will run out. You could see the market start penalizing the stock for it, like conglomerate discount.
Where the parts seem worth less together because one is dragging it down.
Precisely. And, of course, any big downturn in the global economy, macroeconomic deterioration, would hit the ad market and hit Meta's core business directly. So what does it all mean? It means Meta is constantly walking this tightrope between massive opportunity and really significant, very real threats. The BUI call basically rests on the belief that the positives will ultimately outweigh the negatives and that management can navigate these treacherous waters.
Absolutely. So bringing it all together, Meta Platforms really is at this fascinating crossroads. You've got this dominant, mature, incredibly profitable core business, the family of apps, that's basically funding this speculative, high-growth bet on Reality Labs. That core business is like a financial fortress, throwing off tons of cash. And that cash pays for shareholder returns, like the dividend, and these huge bets on AI and metaverse. It's a very clear picture. Solid foundation, risky but potentially huge future.
And based on that comprehensive analysis, looking at the strong financials, the dominant market position, that wide moat, and a valuation that seems pretty compelling given the growth and risks, the final recommendation from this report for Meta Platforms Meta is indeed a BUI with a 12-month view. Which leaves us with a final, maybe provocative thought for you, the listener. How might Meta's massive bet on the metaverse, which some see as just a colossal gamble, how might that fundamentally change not just their business, but like the whole way we interact digitally over the next 10 years? What kinds of personal choices might we all face as these, immersive technologies become more and more a part of our daily lives?
That's definitely something to think about. If you want to stay ahead of the curve, get the fastest, most frequent updates on complex topics just like this one, make sure you hit that subscribe button. You won't want to miss our next deep dive.